we'll end with a little myth busting, as we usually do here. Today we're looking at the race to zero ETFs. Our dear friend Jason Zweig, you see him in the Wall Street Journal there last week, out with an article over the weekend titled, "Why You Should Think Twice About Free Funds," highlighting how expense-free doesn't necessarily mean risk-free. So how do these funds actually do zero ETFs? Well, there's a number of ways that happen, including lending stock to clients. They also sell other products. And of course, oftentimes, Dave, they'll have lower interest on their cash funds.
Yep.
Nothing is free, is I think the point here that Jason's making, we've made many.
Yeah, it's absolutely true. And I think there's also a question of diminishing returns. I mean, we just saw the launch of, or the filing of some zero fee funds for a while. They have a waiver for a year. The question you have to ask yourself, is that really better than, say, the 3 basis points you pay Vanguard for similar exposure?
Yeah.
That's $30 on a $100,000 portfolio every year. Most people spend that on pizza without even thinking about it.
Right. Have we made too much of all of this, Ben? Zero. I mean, the public seems loving just free anything. Well, I'll buy it. But $3 per 10,000 for 3 basis points doesn't make that much a difference if you're making up for it or paying for it in other ways. In other words, are we making too much of this free ETFs business?
Absolutely, especially as we get ever nearer zero. I mean, I think if anything, there's a big risk that investors could be kind of penny wise, pound foolish, that they unlock sort of a tax genie by moving wholesale from one platform to another, that they're increasingly incurring costs that are less directly visible, less measurable in the form of opportunity costs. So I'm earning 0.01% on my cash balance as opposed to 2.25%, which I could be getting at an online savings account. So costs are beginning to kind of creep into the dark. There's no such thing as free. If you're getting something for free, odds are you're subsidizing that by paying for something else, whether explicitly or implicitly.
Right. Now, Cathie, your funds are not free, nor are they 3 basis points, but we're paying for your insights and innovation, right? But do you agree with the general point? Low cost is not always necessarily, don't always just buy low cost just because it's 3 basis points or 5 basis points.
Right. So our fee, I mean, we are doing a lot of original research.
What is your fee for the
75 basis points.
Okay.
So that would compare to maybe 1.25 for a mutual fund, right? What we believe is happening with these zero fee funds is that they tend to be the broad-based indices, right? Easy just to mimic an index, doesn't cost very much to do that. A machine can do that. But we think they are filling up with value traps because of all of the innovation that we're researching. So we think we're at the beginning of the pendulum shift away from passive back to active as more and more people recognize this.
Well, we'll see. That's going to be we've been dealing with that call for a very, very long time. It hasn't happened yet, but there's not a lot of Cathys out there, though. That's part of the problem.
Definitely.
You got to admit. Am I wrong?
Definitely true.
Not.
Definitely true.
Where do you find them? You're one of the very
in her office,
we dragged you over here. It's like seeing a unicorn. Like, here you are. Hey, an active manager that actually outperforms. We finally found one.
No, well, I think innovation is key. Innovation and exponential growth. I think in a slow growth world, you've got to have some innovation.
All right, Cathie, thanks very much for joining us.